Hello, everyone. Thank you very much for being on this session about PeerTalk series, Investment in Infosec Startups in 2020. Today, I'm really happy to welcome Dino Boukouris, Director of Momentum Cyber from San Francisco. Welcome, Dino, and thank you for joining me in this session again. This is our second one. So please, before going into further discussion about areas of investment, recommendations for startups, founders, and entrepreneurs. Dino, could you tell us a little bit more about your profile and how did you get into this industry and expertise, please?
Absolutely. Thank you, Magda. It's really a pleasure to speak with you and your audience. Happy to go into as much detail as we have time for. So my background, I'm one of the founding members at Momentum Cyber. We're a 100% cybersecurity focused advisory firm, and I'd say my background is kind of a couple, the intersection of a couple passions and interests of mine. I've been in the technology industry now for 14, going on my 15th year, across a number of different sectors, aerospace, automotive, medical device for quite some time, and then cybersecurity most recently. Always moving kind of earlier and earlier stage in my career, and I'd say when it comes to kind of the investor's perspective, I gained a lot of that expertise when I was first studying at Berkeley, and then now I teach the venture capital class actually at Berkeley for their MBA and weekend MBA program with two other kind of long kind of career VCs in the Silicon Valley area. So, with on one hand, very cybersecurity focused on the advisory firm with Momentum, and on the other hand, through kind of academic pursuits and my teaching, I stay plugged into the venture capital community.
That is fantastic. Very interesting that you are even teaching that. I definitely believe that there is a lack of courses in general, around of how to invest and learning that expertise that comes up into building a new ecosystem of startups. But this brings me to another first question that I just thought about while you were discussing. What's the landscape currently in the US in terms of cybersecurity? What do you see as a main focus around new emerging startups?
Of course, the landscape has shifted, evolved, and morphed over the last few months, of course. So a lot of my viewpoints are going to be colored by that. I would say there's a few key considerations of what's happening right now. I think the most obvious is, the fact that we now have a more distributed enterprise network. So when you look at the amount of traffic that is coming from the home in these enterprise networks, I think the average used to be around 10% or so in the past, and we're at about 80% of traffic in the enterprise is coming from people's homes. And this is kind of during the work week. On the weekends, some of the studies we looked at showed that up to 50% of traffic is also coming from home as well, which means there's not only more people working from home during the week, but there's more people working in general, even on the weekends. At this point, so it's interesting to see how the enterprise has become more distributed. So while normally my answer of what investors are looking for, might be one answer, I think right now businesses and even some of the investors themselves are really focused on ensuring connectivity, business continuity, all without kind of compromising security at their organizations. And what that's led to is, I would say, we've seen, and it kind of has happened in phases with what's going on in the globe right now. But this initial phase where everyone scrambled to work from home, we saw kind of the rise of a lot of the essentials that folks needed in order to even to do so. What I mean by that is, I mean, simple things like, do we have enough laptops? Do we have, laptops with security software layered on it, whether that's MDM, endpoint solutions, additional VPN connectivity licenses in order to connect back and, call back into the network, if you will, MFA. So everything that under the historical and traditional kind of security architectures that you would need in order to remain connected. But what we quickly saw is that we very quickly overloaded our infrastructure. We saw that, using VPNs to backhaul all of your traffic, or 80% or 90% of your traffic, through appliances that were designed, to handle, an order of magnitude less traffic, just created a jam. So a lot of folks started looking at, obviously there's the Band-Aid solution. So let's just buy more appliances, or, let's just buy more licenses, or try things like, split tunneling of VPNs or whatever that might be. But what we saw is there was quickly this turn to what are the technologies and what are the capabilities that we need in order to really support this remote workforce. Arguably, does anyone think that 80% of traffic we see today coming from home, up from 10%, does anyone believe it'll go down again to 10%? I think we'll never see that number down that low. So I think, when people talk about the new normal, even after, we get back to some level of normalcy in the world, I do believe that we're going to see a significant increase in a distributed enterprise network. And I mean, we see that with companies like Twitter and others that are already saying that if employees are able to perform their work functions remotely, that they're going to leave it like that indefinitely, as possible. So I think there's an increased emphasis from investors, strategics, as evidenced even in the midst of all this chaos. We saw, Palo Alto make their acquisition of CloudGenix on the SD-WAN side of the house. So we're seeing folks, and this is true for investors as well, really looking at what are these technologies that'll kind of take us forward in this new normal of working. So for now, a lot of what we're seeing is related to, enterprise networks that, let's call it network security delivered in the cloud is an area of interest. If you think about it, the home network is now an extension of the enterprise network. So security and tools and capabilities in order to secure the home network are very much top of mind for folks at this point in time. Security operations, and not the traditional sense of just a SOC, if you will, but companies that are really able to deliver virtual SOC services to enable remote analysts working instead of needing, a room full of analysts and folks working side by side with eyes on glass to protect their networks. We're seeing an uptick in those companies that have really, really nailed that ability to have a remote SOC. Aside from that, we saw the uptick, I would say, in phishing campaigns, the number of domains that have been registered with some type of tie-in to coronavirus, COVID, and from the records of who's making those registrations, all the DNS and who is information, we know for a fact that there's a large number of those domains that will be used and are being set up to be used for kind of malicious purposes. So we're seeing the rise in spear phishing. We're seeing kind of the rise in social media attacks. The Verizon Breach report that just came out this past, I think Monday actually, showed that I want to say 22% of the breaches last year were a result of or had an attack vector that involved social attacks. We personally think that's going to be on the rise throughout 2020 and 2021. But for now, companies and investors are, looking at ways where since there's going to be kind of an increase in these kind of vectors, what other companies and capabilities can we invest in to protect us there? And lastly, I would just say, with the discussions we've been having, there's much more of a focus on, and this kind of ties back to the first topic of kind of a more distributed network, but this idea of getting people behind these walled gardens and secure applications is really starting to evaporate, and it's more about the identity of the user. Not to use too many buzzwords on here, but everyone is now kind of re-energized the discussion around zero trust. They've re-energized this conversation around, caring more about who you are, what data you have access to, and how do we secure that data wherever it may reside or however it is transferred and, transported throughout the internet. And those, I would say, are some of the areas that at least we've seen and we've heard investors and even strategics being interested in.
Yeah, thank you, Dino. This is very, very interesting. For sure, there is a change and a shift in the infrastructure. And of course, when we're talking about that, we mentioned a change in the attack surface of companies with a distributed setup. I do not think definitely that we will go back into the 10% of remote working. Employees, some of them especially, got the comfort of working from home, but as well, the companies realized the increase in productivity, the decrease in costs, because they will not need to have all those offices, and therefore it's a win-win situation. But then from a cybersecurity perspective, of course, what is the balance between comfort as usual and security? So I think there's something to work on. The other point that you mentioned that is extremely interesting is the zero trust concept. And I do think that there is still a lack of awareness in that particular concept. And as much as I hear and see some, hype and vibe going on in the US about that concept, I do not see it in other parts in the world. So I'm looking forward to see how it evolves. Then now this brings me to the next question, Dino. So what do you think actually VCs, companies and VCs are actually doing currently? Are they holding on investing into startups that are, let's say, a little bit more in the traditional business security models, or are they still looking at the startups like before the COVID-19, but with an additional focus on this decentralized enterprise network aspect or solutions?
It's a great question. I would say I feel like we touched on maybe the sectors of interest, but now maybe let's talk about the mentality, if you will. There's a couple different schools of thought for the investors, at least the ones that we've spoken with that are a bit more cybersecurity focused even. And it really kind of breaks down like this. There's kind of one camp of investors who are in a position where they maybe have recently raised the funds, so they have lots of dry powder to invest. And the first phase is just doing a quick check with their portfolio companies to see if their portfolio companies are in similar positions where they themselves have enough capital to get them through some of the hard times. Now, assuming that's the case, then those investors, what we're seeing is that they've all, or a majority of them, even for momentum, they've reached out to us and they wanted to have, briefings to not just get our views on the market, but to make sure that we know that they are open for business. They are evaluating opportunities. They are looking at new investments, that they are very much interested in continuing to evaluate things. But there's a couple of catches. One of those catches is, I believe, the time frame that it'll take from start to finish in order to close a fundraising round has significantly increased. And whether that is due to, I would say, a couple factors. One, I would say strategic activity in general is kind of a function of confidence and the ability to build confidence and build trust and, build that comfort of something that you are trying to accomplish via the phone or potentially via Zoom or WebEx, whatever that might be. I believe that it takes longer to do so. And that's going to be true, and it seems to be true, whether you're convincing someone to purchase a new cybersecurity product, whether you're convincing someone to purchase some equity in a company to raise money, or whether you're convincing someone to try and purchase your entire company. There is this idea, and I'd say the sentiment that things are just taking longer. I was on the phone actually today with a very well-known investor, based in Southern California, and they said, we've never been busier. We have so many conversations, calls, and get to know you type sessions. But we're all wondering, are we actually going to close a deal during this time? Are we actually going to pull the trigger? Are we going to sign the documents and make it happen? Or is this just a lot of preparation and business development work? And when the uncertainty gets removed a bit more from the global economy and just the globe in general, maybe that's when there'll be a kind of this cascade of deals that we're building up in the pipeline. So the analogy was actually perfectly put earlier today. It's kind of like saying, the rate of demos is up, but it seems like the rate of people signing off on the purchase orders to buy the solutions has decreased. And I don't mean that in the behalf of the companies. This is the same kind of analogy, I think, works with the investors as well.
Yeah, that would make sense, absolutely. And also what I have heard or echoed in this part of the world is very similar. So the people, even companies, might get busy with the calls. It's easier to set up the meetings. You don't need to go somewhere. You just send a Zoom link or a Teams link, and therefore you can start the discussions. But like you mentioned, one very important aspect in any business transaction is the trust. And as we are doing that only through video calls or just through calls, then this part of trust requires more time to be built. And therefore, at the end, it might take several months rather than weeks into closing any deal. So for sure, I see the same aspect. What I have as well noticed is that there are some venture capitals who refrain from investing in other foreign countries, which they have been doing. And this is not specific to US or any other country. Because basically, if a VC is in Singapore and was investing around the world, now due to the uncertain times, they just focus on Singapore as an example. Do you think that this is something as well that you have seen in the industry?
The question of geography hasn't necessarily come up, but I think why that makes intuitively why that makes sense to me is that the general feeling is the investors are gravitating towards reducing risk, and risk can come in one of many different forms. I think that one form of risk, let's say, could be the stage of company where there might be, for somebody, let's say in the private equity world that, maybe their roots are investing in larger, more established companies with predictable revenue, possibly profitability being a factor as well. In the last few years, I'd say we've seen folks like that migrate down and move earlier stage so that maybe they take on a company that's earlier, maybe they're providing kind of primary growth capital because the company is still burning money. I would say that behavior is kind of reversed course, and that investors are trying to find maybe safer bets because of the risk and the uncertainty that's kind of systemically now in the market today, that they're trying to cut risk elsewhere. I think one of the risks that you highlighted of geography also plays into that, right? There's probably certain geos right now that are perceived as higher risk than others. I mean, if you ask me, I would have a hard time telling you which part of the world is lower risk today. I think there's different ways of looking at it, different ways of looking at the market, but I could see why investors would feel more comfortable. And again, it's a function of this, risk tolerance, comfort, confidence, and that we're going to feel more comfortable and more confident when we're closer to home. We're going to feel more comfortable and confident when it's companies that we really believe in and that we've been able to get to know over time. I think, that geography is just yet another factor of what are people doing to make up for that lack of comfort and confidence and to minimize risk in today's world.
Thank you, Dino. Yeah, indeed. And I like the fact that we're talking about risk because it is the same when it comes to cybersecurity and, shifting the discussion from just seeing it from one perspective to addressing the overall risk and understanding the risk appetite of whoever you are discussing this with. So this brings me to the next question, which relates to the fact, so if I am, let's say now a startup founder, what would you recommend to that particular entrepreneur in terms of investment? Should they wait until this situation, gets a little bit better? Should they still continue to pitch to VCs? And if so, if they continue to pitch to VCs, does that mean that they should eventually review the investment strategy, perhaps go to a lower round instead of targeting too ambitious as well, I would say, checks? How do you see that particular aspect?
I would say, so a couple thoughts on that. One, I personally would recommend, since the reality is a lot of times investing is, for lack of a better analogy, it's almost like, dating and getting married. You're marrying that investor to some extent for a longer term period of time. You're committing to one another. And the fact that you're so easily able to, let's say, date at this point in time, and you can take these meetings. Investors are absolutely willing to talk. I think it might even be easier to get on the calendar of some of these investors today. I would recommend that if entrepreneurs can afford the time, that why not begin building the relationship sooner? While you may not want to launch a full-blown process where you're actually, going out and communicating certain timing. I think that instead of just waiting 6 months and then saying, well, instead of taking 6 months or 3 to 6 months to fundraise in today's climate, it might take, let's say, 9 to 12 months. And I'm just throwing out examples for the sake of discussion here. Instead of waiting 6 months just until that time window can shorten, why not take advantage of the time now to get to know folks? So I would absolutely still reach out to companies or investors. I would make sure they're familiar with your company. You start building that rapport sooner. Sure, it's not the most efficient method of doing so, but the earlier you have the discussions, when you're ready to pull the trigger and go on to this fundraising round, you're going to be in a much better position. And I think the same is true for strategics, right? Strategic investors, we're not really focusing on M&A right now, but from a strategic investment, why not have the discussions earlier? Why not get on their radars earlier, get to know their business development team? Maybe you have 1 or 2 extra calls than you normally would, but that call might be with the head of product or the somebody on the investment committee. You just never know when an extra relationship, going that extra mile, and maybe 1 or 2 extra conversations will build confidence in them, so that when you do have the explicit discussion about fundraising, then you can actually hit the ground running, so to speak. So short answer is I don't think that it makes sense to hold off on having conversations, but I do appreciate that now is probably not the best time to launch into a full-blown fundraising mode unless you don't really have a choice, right? If you're not raising your first round and talking about a seed stage or, Series A type investment, you might be in a position where your company is running out of cash, in which case you can't afford the luxury of waiting. So you have to make the best with what you have. And unfortunately, right now, it happens to be a buyer's market, buyers of companies, buyers of equity. It's just something you'll have to work through. You'll have to mentally try to prepare yourself for, a more rigorous process of diligence, extended timelines. And of course, there's going to be, a discussion on valuations. And, many investors have the viewpoint of why should I pay the same price for a company today that I would have paid a quarter ago when there's a natural dip in the markets. Granted, that there has been been recovery, and we can argue whether or not that recovery has been optimistic or too optimistic. But to that extent, we're still seeing investors that expect kind of a discount as well.
Yeah, this is as well, super interesting point, because the same happens with Chief Information Security Officer waiting for discounts and freebies in this particular time due to the situation, of course, and uncertainty so basically from the overall I would say environment. Anyone and everyone is trying to take this opportunity to decrease any costs, and that is relevant, or we can see it from different perspectives, either from the decision makers in that in the enterprise environment, or either from the VC side when it comes to investment. And therefore, when you mention the valuation or discounts, what is your take or your feeling about evaluation of a company?
I'd say from what we've been hearing, the typical number, and maybe people just get comfortable with something, and because it seems like everyone has gravitated to talking about roughly a 20 all the way up to maybe a 40% discount. I think 40 is a bit too extreme, but the most frequent number, the mode here of that I've heard in these discussions is folks probably talking about a 20% discount to pre-COVID valuation levels.
Oh, wow. And what about the valuation has been externally approved within the COVID situation? Does the startup, founder has still hope that he will be or she will be able to negotiate?
So I think you'll be able to negotiate depending on the circumstance. If you can, there's two sides of the coin. If you can, in order to even have a chance of getting the pre-COVID type valuations, you really have to make the case as to why not only your business, but think about the customer segments that you're going after. Think about the type of solution that you're offering, and think about the new normal and the new reality that we'll be living in the near term. Why that may or may not matter to you, right? Or maybe you're positively affected. Maybe you have a solution that's going to be, even more rapidly adopted because of the conditions. I'd say in the really early stage companies, I'm not so sure it makes a ton of difference. What I mean by that is you don't really, if you're just developing a solution and trying to create your MVP, I don't think it makes much of a difference if you start a company now. In fact, I think there's a lot of folks that are kind of evaluating and reflecting in their lives. I could say a number of discussions I've had even this week of folks at very established companies that are like, you know what, I've been thinking maybe I do want to do another startup. Maybe I do want to try something different. And I think that is the reality that now's a great time to start a company. It's a great time to focus on the product and the product market fit. I think you'll be able to get a lot of feedback, especially if folks are willing to hop on a Zoom or a call a little bit easier. If you're not selling them something, it doesn't matter whether they have budget, but having a discussion with your target, chief security officers or whoever that customer might be, chief privacy officer, so if you're able to justify that it doesn't matter because you're not going to sell product for 12 months, or even if you are going to sell product that you're not really focused on revenue, you're more focused on customer validation and feedback. I don't really think that, it's too much of a burden to do that today. But if you're, a Series A company going to raise your B round, and you really need to show that there's product market fit and customer traction, and your trajectory needs to be nice, and you need to be growing at a healthy clip, I think those are the companies that I would be a little bit nervous for. But if there's a founder that, wants to start something new and it's more about the technology today, I'm not so convinced that that today's climate is a bad time for them to think about starting their company.
And that brings me to my next question, Dino, because when we're talking about very early stage startups or first time entrepreneurs, I do believe that they still lack a little bit maybe visibility or understanding of the different rounds, and when is the pre-seed, when is the seed, and when is the Series A? What makes a difference, and who to approach at which stage? Can you enlighten us about that as well?
Yeah, I would say the definitions have morphed. If you look at, and I don't have the data in front of me, but if you look at the average size of a Series A over the course of the last, let's say, 10 years, I believe it's at least 2, if not 3 times larger than what a Series A used to be a decade ago. The same is going to hold true for seed stage, maybe not the exact math per se, but seed, Series A, Series B. My advice is to really think about what stage your company is at and to fit the tool for the job. And if you are a company that really is, looking at, just the initial product and ideation phase, you're going to want to try to work with maybe investors, first it's kind of the angels and friends and family that have, no clue what you're working on most likely, but believe in you as a founder. But if you're at a stage where you need a certain type of investor, I would say then I would target it based on the needs that you have. If you have the size of the round that you're looking to raise, how much capital do you need to get to the next step or the next step function and valuation? So if you need to, build a product and you need X amount of capital, depending on how large X is, then you might be in the category of, you're really talking about seed stage investors. Because if you're looking for only, let's say, $100,000 check or $250,000 check, and then obviously examples that I'm using are more Silicon Valley sizes here, you wouldn't go to someone that only does Series A investments and their minimum check size is $1 million, right? So, if it happens to be your first round, you can call it seed, you can call it Series A. Really, from my perspective, it doesn't matter as much. But, which type of investors to target is more a function of where you are with your company and how much capital you're looking to bring in.
Yeah, that means basically, if I recap this correctly, it doesn't matter again how you call it, that it's actually criteria on your growth. So if you are a startup that is already working, generating revenue, has shown a target, and you're looking for an investment of let's say 1 million to 2.5, then you can actually go and target VCs that are used to write this kind of checks, and basically you can call it Series A. I'm correct?
Yes, exactly. I mean, one perfect example, I won't use the name, but there's a company we're working with. Their first round of capital was after they hit 25 million in revenue. They bootstrapped the business until 25 million. They took their first round of capital. They called it a Series A, but if you compare them to 95%, 99% of the Series A companies on the planet, they're nowhere near the same kind of profile. So it can be confusing to say that, the Series A came from, a large, bank, as opposed to some people do a Series A and it's, individual investors that nobody's ever heard of. But at the end, if you look at the companies, they're probably, early stage revenue, and it just made sense for them. So I would say not to get too hung up on the naming or, kind of the outside perspective. And that's really all you're getting there. And it's more, I would focus on the amount of capital and the right investors given the stage that your company is.
Thank you, Dino. And here, I'm conscious of time, so this brings me actually to perhaps the last question. I think we have an overview about the market, very clear recommendation on what to do during these challenging times, and especially what to expect. But what would be the 3 main points that you would, let's say, mention to every startup entrepreneur that eventually has been a little bit, negatively impacted, even from the growth perspective, even from the, moral aspect of it, because of course we are all human. So whenever the situation is so uncertain for a startup entrepreneur or for a founder, it might be a little bit challenging. So 3 points that we would like to close this podcast with that will give hope and positivity to anyone who is listening to us.
Sure. Happy to offer some thoughts here. I'd say the first one, because I think it's very important to focus on, your people's psychology and, really talk about just being motivated to kind of just continue the journey, to not really give up because of a lot of challenges that we've been talking about, I should say. One thing I would just bring up is that really amazing companies have been started during some of the worst downturns. I'm sure it's not the first time you've heard this. Off the top of my head, and hopefully my memory holds true. But if I'm not mistaken, Airbnb got started in, I want to say 2008. In the middle of the recession, and arguably is one of the top companies around nowadays. And you look at the valuation, and it's pretty impressive. Square was another company that was started during really hard times. Talk about financial services crisis, 2008, 2009, I believe, when they started. And, you're talking about, card readers in order to read cards and help merchants in the time when the economy is in a full-on recession, right? Groupon, which, you can argue which way Groupon is headed, but same thing is true with Venmo. I mean, the list kind of goes on and on. I mean, back in the day of kind of the .com bubble burst, Netflix was started, I think, before that, but, I think later, 97, 98 timeframe, so that they were, trying to build their company in the midst of the .com bubble burst. So just because it's a recession or it's hard times, hopefully folks don't get discouraged, because some of the best companies come out during these periods.
That's a very nice. I think sorry, this is a very nice point. Definitely, I relate to some stories that I have read about those companies. So yeah, some of them indeed took the opportunity to build a great story, a great achievement, and companies that are still around with very high valuations. What is the second point?
I would say the second point is the reality is times like these they are a part of business, right? I mean, sometimes you're forced, or companies like to maybe not ask the tough questions and really, look at their business critically. I think if there's one benefit of all this, is that the businesses that, do survive and come out on the back end, I believe are going to come out stronger. I think they're going to come out more efficient. They might be a little bit leaner. I think that they will be, a bit more cost effective. And I think it's healthy sometimes to have a reset, and to some extent, not just financially, but talking about working more efficiently with people. I know even personally, like looking at the way we work at Momentum, we've had some really great ideas come about over the last couple of months, and whether that's related to content or business development efforts, the creativity and kind of, I forget the exact saying, but basically necessity here is a fantastic, driver in order to be a more creative company. And I think that's going to be true during this time as well. So there are bright sides to all of this as well.
I would say necessity, yes, creates or pushes individuals to think outside of the box to find solutions to the problem. So I totally agree. And then what is the last point that you would say as a third and last recommendation?
I would just say that the last point is that folks do need to be realistic, right? As much as we all want to think that that this is just a temporary thing. Yes, it's temporary to some extent, and it's all relative. But I do think it's important to have a realistic outlook on expectations and to factor those outlooks into their, company projections, and to really think about, time horizons to close a deal are likely to be extended. If you had a strong Q1, I don't think that that's reason to be super bullish on Q2 and Q3, because the ripple effects have not yet had a chance to fully propagate, I think, into the economy. we'll probably have a number of really maybe not surprising, but just terrible earnings calls on the horizon for a number of companies that are out there that will probably send further shocks in the market. So I do think that folks should prepare themselves for a bit of a roller coaster ride. I don't think it's anything to sound the alarm and that, people should be thinking that the sky is falling, but don't be alarmed if, those a key customer is going to have to churn because they happen to be, let's say, in the retail or travel industry and they're struggling right now. So there's a certain level of honesty and intellectual honesty you have to have, especially during these time periods. So I would say while there isn't, there's absolutely reason to be optimistic, to have hope, and to see the silver lining, you do also have to be pragmatic of the current scenario and just to make adjustments that are necessary, and maybe just adjusting and realigning expectations sometimes goes a very long way, even from an emotional perspective, because nobody likes to have unrealistic or unattainable goals. And I think having a more pragmatic view of your business and maybe near-term forecasts and the ability that you'll have to kind of, accomplish everything you're setting out to accomplish, you might have to live with something that just doesn't quite get there. So it's important to just be realistic as well.
Thank you, Dino. So basically for our listeners, they need to remember that some of the best companies have been founded in crisis times. The second point, necessity creates opportunity. And then as lastly, be realistic rather than just opportunity, be realistic and ensure that you keep that positive aspect as well. But don't forget that, the reality is as it is. Thank you so much, Dino. This has been very interesting discussion, and I hope all our audience has benefited from your advice and your views of especially challenging times and COVID-19 uncertain future, I would say, because again, it's come down to the fact that, it is a period that might be temporary, but the temporary is something that's variable. We might as well, or we see reports talking about the second and third waves. So until a vaccine or a cure is not found, we probably have, as entrepreneurs or founders, still a long and difficult journey ahead of us. So I think your valuable insights have been or will be very, very helpful for whoever is listening to us. So thank you again, Dino. Really appreciate having you on this podcast today. And I'm looking forward for more discussions in the future.
Thank you, Magda. It's been an absolute pleasure. I had a lot of fun today.
Thank you. Thank you.